Thanks so much for tuning into Trade Talk. I'm Neeraj Shah, and it's interesting what's happening in the markets in the last few days. Both Friday and Monday we've done reasonably well relative to what the global markets may have been indicating. We passed the earnings season. There are a bunch of events that have happened, including the Supreme Court verdict that came out, the committee verdict that came out on Thursday with regards to Adani Group and what that group stocks have done as well. So lots happening in the market in the last few days. A good time to get in an expert market opinion on what to make of all the events happened thus far, including the earnings season that has gone by, and what is the outlook ahead for FY24. Well, we are almost 2 months past into FY24, but you can very well say we're still at the start of the year. Rajesh Kothari of AlfAccurate joins in right now with his thoughts on how does he see equities from his prism. Rajesh, great having you. It's been a while. Thanks so much for taking the time out.
Thank you, Neeraj.
What did you make of the kind of outperformance that, or rather the performance that the Indian markets have had from the lows recently? And now that we are kind of stabilizing or stalling or consolidating at the current levels, there is equal argument for it being an expensive market relative to what earnings will come up in FY24. An equal market for why India versus the rest of the world is not as expensive as it was before. Which side of the table are you on?
Well, clearly, Neeraj, I think let's believe in numbers rather than narratives.
Sure.
Right? I strongly believe in numbers than narratives. And if you look at FY23, particularly last 18 months, they were strong in the world economy. And in that stormy world economy, if you look at the corporate India growth for FY23, it was a one word which summarized it is a resilience. And therefore, for the first time in history of last 20, 30, 40 years, where despite Dow Jones in the global markets went down like hell, the Indian markets were still quite steady. Of course, it corrected from its peak of 19,000 to bottom of around 17,000. But if you see overall perspective, that fall has been much lesser, even at the worst, the trough time I'm talking about. The fall has been much lesser than any other global markets. And the reason is obvious, because of the strong, resilient earnings growth. I think Indian economy has done extremely well. And from here, I think is going to be now into the new growth orbit over next 2 to 3 years. That's what our view is. Valuations are still very reasonable levels. If you look at from the valuation perspective, in absolute terms, from 19,000, we are at, say, 18,200, 300, about, say, 3-4% absolute discount. If you look at from the timelines perspective, almost 18 months of time correction. So maybe 10 to 11% if you add to that 4 plus 11 gives you 15% discount. And during this journey, the earnings growth has been up 20%. And if you add to that, we are almost at 25 to 30% discount. In absolute valuations, our Sensex valuation or Nifty valuations, we are below 10-year average valuations on price to earnings basis. We are almost at par in terms of price to book basis. And both the earnings growth of next 2-3 years as well as ROE of next 2-3 years is going to be better than where it used to be last 10 years. So if you ask me from any slice and dice, the market looks attractive with the 3 years plus holding period.
Okay, so I would take it that you are constructive at these levels and you are not even tactically sitting on some bit of cash. You are putting in all money to work.
No, absolutely. We were holding cash levels till February, and then since February we have been deploying. And I think so we are quite positive now.
Okay, so if I would presume that by having interacted with you in the past, that you are a combination of somebody who looks at the kind of earnings growth and not just pure value, but you're not a growth at any price kind of an investor. So based on a combination of both the kind of earnings growth that has happened in Q4 and FY23, as well as the kind of valuations that some of your portfolio companies or some of the other companies might be trading at, where is it that you are putting incremental money to work? Or where is it that you put incremental money to work in the last 3 or 4 weeks, if you will, or last 2 months?
I think, let me handle, I think your one question had a lot of sub-questions within it. So let me put one by one. Let me start with the fourth quarter of FY23. And corporate India has reported very strong numbers in overall terms. Let's first talk about the banking sector, because that's the backbone of any economy. Right? And for the first time, I would say in last 10, 12 years, the kind of net interest margins the banking sector which has reported, along with the kind of credit cost, one of the lowest credit cost, not I would say one of the lowest credit cost probably in last 10 years, and the highest margins compared to last 10 years. This combination is a rare combination. You know, of course, there is a question mark whether the net interest margin will sustain or will it reduce over next 2 quarters. Well, even if it reduces over next 2 quarters, how do you see FY25? That's what is more important. It's not just quarterly numbers, right? And we think that FY25 is also going to be reasonably strong year for from the NIM perspective compared to what we have seen the average of last 10 years. So I think banking extremely has delivered strong numbers, which is a good news for overall market, overall economy. The other sectors which are reporting good numbers and probably incrementally will report good numbers is the probably consumer sector, the automobile sector. Please remember FY23, there was a headwind in terms of the high inflation, high commodity prices, unavailability of semiconductor chips, supply chain disruption, and many more such headwinds. I think FY24 is going to be a year of tailwinds. The inflation is a worry of past. High interest rates is a worry of past. The supply chain issues are worries of past. And therefore, many sectors, whether it is an automobile, whether it is a cement, whether it is a consumer, these sectors we expect to report good improvement in profitability in FY24 compared to FY23. So that's basically in overall earning terms. One sector, of course, where we have been underweight since last almost 15 months is the IT sector. And this is a sector where it has disappointed the street because the earnings growth has been much lesser compared to what everybody thought of. Of course, we sold and we reduced the exposure on this sector almost 1 year back. So we are adequately underweight on this sector and we remain underweight as I'm speaking with you. So that's overall how do we see from the sectoral perspective. And of course, one sector which has reported great positive surprise is the capital goods. And why this is important is not only it matters to that sector, but it also gives you peek into the how do you see the economy growth over next 2, 3, 4, 5 years, because capital goods is a leading and then it leads to execution and better growth for the economy over the years. And across this sector, capital goods, most companies have reported very strong order inflow growth. That's something very, very critical. If you look at the breadth of the order book, every sector, most sectors within each company, sub-segments, domestic, exports, everything is done reasonably well. And that also makes us further positive on Indian economy and Indian market. We have been overweight on capital goods sector from almost last 2 years across our PMS, whether it is a AAA India Opportunity PMS, where we own roughly 13 to 14%, or whether it is a AAA Budding Beast, where we own roughly 24% in capital goods. And most of these companies are reporting best of their earnings of last 5-10 years.
Okay. So here's the question then. Where is it that you believe that valuations may not be in favor, but growth is, and in some cases, even valuations may be in favor? Like, for example, in the case of cap goods and high quality cap goods, the ABB, Siemens, Cummins, and I'm just using that term high quality because to denote the MNC thing, but there are a lot of other Indian companies also, L&T, which are high quality, but the MNC ones are trading at premium valuations, right? So there might be growth in the future, but the valuation comfort may not necessarily be there if you look at the trailing 12 months earnings or FY24. But in certain pockets, Rajesh, the growth may be strong and the valuations are also comforting. So where is it that you're making that distinction? Can you tell us within your portfolio companies, for example, or your portfolio themes?
So we believe that the capital goods continues to trade at a reasonably attractive valuations. When you
even the MNC ones?
Yes, I tell you why. Because how you look at it is something very important, correct? So if you look at 2003 to 2008 cycle, when the BSE Capital Goods Index went up by probably 5 times, 7 times, 9 times, correct? Where Sensex went up by 5 times. Capital goods index went up by 15 times. So question is, do you believe that India is at an inflection point of capex? Because if that answer is true, then the earnings growth will be completely different compared to what Street is right now assuming.
Got it.
So 2 years back, let me tell you, like 2 years back when we bought capital goods, nobody believed that those earnings will reach. Nobody believed that ABB or, please put a disclaimer, these are the companies which we own in our portfolio.
Okay.
So nobody thought that these companies will deliver, 25% order intake growth, 25% revenue growth, and 25% profit growth. Because from 2009 to 2020, these companies have reported almost flattish numbers, below optimal number, below GDP growth number, right? And ultimately, this company delivered in last 2 years. So valuations actually have not improved. Valuations are same. The earnings growth has come. You might see stock price appreciation, but that doesn't mean that valuations have expanded compared to 10 years average price to earning valuation. Right? So we are still positive on this theme. That's number one. Banking is one theme where valuations are not at its peak compared to profitability and credit cost, which is at the best of the combination. So I think that sector also provides good margin of safety. I think if you look at from the consumer space, even this space was impacted a lot in last 3 years. We have started bottom picking in a consumer space now, because from here, the inflation, which was the biggest villain for this sector, will turn in your favor. And also the rural demand, which got impacted significantly, particularly in last 12 months, we believe you will see improvement in rural demand. So this sector will also see what I would say positive surprise on the earnings growth over next 12, 18, 24 months. The fourth sector which we believe will do well is related to more of a bottom-up approaches, whether it is auto ancillary companies or whether it is a companies which are into specific related to logistics, or whether we talk about the building material related companies. There also we see good improvement in gross margins, in operating margins, as well as better growth in revenue and top line. So that's how we are basically positioned from our portfolio perspective.
Got it. Lovely insights, Rajesh Kothari, and thank you for taking the time out and joining us in a midday conversation. Usually we talk in the mornings, slightly longer ones, but this time around, this will suffice. Great having you, and looking forward to having you more often on the platform.
Thank you, Neeraj. Thank you very much.
The pleasure was ours, and viewers, thanks for tuning into this conversation.